Howdy, folks. Welcome back to the weekly wrap up for December 31st, 2021. Thank goodness it is the end of this year. It has been, it's had some goods and bads, but I'd say for most folks, it hasn't been the best. So, and frankly, the last 2 years have been pretty rough on a lot of folks. So, some bad news today. I don't know if any of y'all have seen in the news where Boulder County basically caught on fire yesterday. And looks like from some of the images, it burned down well over 1,000 homes, businesses, things like that. So really sad. We drove back yesterday early from our little mini vacation just because we wanted to beat the winter storm that's heading this way. So it is, like I said, a little sad. And a lot of those fires crept into the northwest Denver area. So I mean, it wasn't just burning up houses like mine out in the middle of nowhere, out in the mountains. These were subdivisions that were just torched. So it's really sad. So I imagine a lot of folks lost some pets and things like that. No reported human deaths, but like I said, it is really sad. So secondly, Betty White passed away today. So I mean, that's whew, I thought that woman was going to outlive me, quite honestly. I mean, she was 7 years older or 6 years older than my grandparents, and they've been gone for almost 8 years now. So it is, it is sad. I enjoyed watching her. I don't really remember her from the Mary Tyler Moore Show. That was a little before my time. I mean, it was on TV reruns and stuff when I was little, but wasn't my cup of tea. And I mostly remember her from the Golden Girls, and not that I watched it a lot, but as a older kid and young teenager, it was on TV. So, and there weren't as many choices back then. So, all right. So let's go ahead and I want to show you what it was like on my vacation here. So let me bring up my scoops. So this is what it was like in our little place where we were at this week. I mean, beautiful location, but the weather was a lot like this. So let's go ahead and watch this for a second. This is me taking the dogs out to go do their business. There's me. All bundled up. There's my pups. Yep. It's my face right there out in the snow, dealing with all the BS that was going on. So, I'm making light of it. It was, it had some things break, which really, were not ideal. And like I said in a video earlier this week, the one of the skylight slash, I guess, heat vents either ripped off in transit down there. I mean, the winds were pretty terrible. Or it was the winds, I guess it was Monday night. It was just, 40, 50 mile an hour winds. So I guess it just ripped it off. And then we had snow dripping on us in bed, which was, just so much fun. So anyways, so like I said, and what was sad was that as soon as, we went over the mountainside, got on the other side from that valley, totally clear. There was no snow on the ground. Sun was out. It was like, in that movie, I guess, Lost Horizon, where, they go to Shangri-La. It was like that. It was crazy. It was like 20, 30 minutes of icy roads. And then you go over the pass and it was completely clear. No snow anywhere, bright and sunny, and, beautiful all the way back up here to just south of Denver. So it really even couldn't even see the smoke from the fires. So, all right, well, let's go ahead and jump into some real news. Let's take a look and see how the Dow Jones did today. Dow Jones was down 0.16, S&P was down 0.26, NASDAQ was down 0.61, small caps were down 0.11, the VIX down again, down to 0.63 to 17.22. So, while the market might be in this kind of like stagnant kind of sideways position it's been in for a few months, The VIX, like I said, pay attention to that. If the VIX starts creeping up towards 30, that's a clear warning sign that we might have some negative volatility in the markets. But until that starts to happen again, let's stay with our core portfolios and go from there. So across Europe, looks kind of mixed. Some red, some green, nothing too high or too low. And then down across Asia, mostly greens. Looks like the Hang Seng was the best looking index there. So, all right. Well, let's look at jobless claims for this week. They came in at 198,000. The forecast was 208. So if we go and take a peek at, let's see here, it's, we're down in that range, where we really wanted to be, around 200,000 jobs, jobless claims. That's typically, a normal number for us. So we're back there. So, like I said, I see that as some really positive news for the economy. Continuing jobless claims came in at 1.716 million. The forecast was 1.868 million. And again, looking back here, this is a pretty significant. Just back, we're more than 500,000 jobless claims, continuing jobless claims, lower than we were just in mid-October. So again, some positive news. And looking back historically, 1.6, 1.7 was a typical week as far as continuing claims, and we were basically there. So, there are still a lot of job openings, simply because people just aren't going back to work like they we would hope. But the unemployment rate definitely, or those filing for benefits, definitely is back in a range where at least I would like to see it. All right. The Baker Hughes rig count came in at 480 today, same number as last week. But again, looking back, over the past few months, we've gone from the high 300s in September up to 480. So that's a pretty significant increase in rigs that are pumping oil. So hopefully soon we should see some relief at the pump and at the price of a barrel of oil overall. So again, there are some positive bright spots to look at. There are some things that are doing fairly well, but then there's the other side of things where there's just a lot of available jobs out there right now. And but again, we're kind of going through a flux right now. Over the last 2 years, we've seen a huge change to remote working. We've seen a huge change to how we shop. So not to say the brick and mortars are going away. I personally still like going and shopping in person for certain things. If I like just wandering through a Best Buy. I would actually preferred Circuit City back in the day. They were actually, to me, a nicer store. But yeah, I mean, there are some things, if I'm gonna go buy clothes, I typically like to go try them on, especially if they're like jeans or a suit or something like that. But if I'm buying sweats or socks and underwear, I can just get that through the mail if need be. So, all right. Well, as far as let me first let's take a look at the markets over the last year. And sorry, I closed this earlier because I had to shut down all of my windows because they were not, everything was running really, really slow. All righty. You don't care about that or that. So let me turn off my charting stuff here. So, all right, let's take a look and see how the Dow Jones did this year. Looks like it was up approximately 18.5%. S&P 500, it was up about 28%. Wow. The NASDAQ this year was up about 26%. Dow Utilities, they were up 15. And the Dow Transports for the year up about 32%. So transportation, technology, those things did very, very well. Utilities, not quite as good. So, and let's go ahead and take a look through the asset classes. These are the holders that I'm using as of fourth quarter. but it'll give us an idea of, across all the asset classes, excuse me, across all the asset classes, how they performed. And, because obviously no one just invests in the, excuse me for a second. Delicious lemonade, good for you. I add pink salt to it because I have trouble staying hydrated. But like I was saying, across all the asset classes, not everything is going to do 20 or 30%. We'll see. Let's take a peek and see across things. So right now I have in my large cap space, I'm in the value space. So value this year actually did very well. Large cap value was up 27%. Mid cap value right now was up 30% this year. Small value this year was up 31. International, let's see here, was up just 8%. International high dividend was up 9%. Let's see, these are diversified emerging markets. They did not do very well, only up 5. And let's see here. Transport, that one was up 17. And then my emerging markets minus China was up 5.6. So we can see domestically in the United States, things were very, very robust. The international and the emerging market space, not really that great for the year, considering everything that's going on. So if you ask, why would you have emerging markets, minus China? If you recall earlier in the year, China had, the potential for a default on their, what was the name of that company? It was their real estate, Evergrande. So I made the decision to get China out of the portfolio for the time being, just because if it falls to, goes to hell, you certainly don't want to be sitting on that. All right. So as far as fixed income, we can see fixed income. This is just kind of your aggregate bond portfolio was up about 0.5% this year. Short-term treasuries down 1%. Short-term corporates down 1.5%. These are your midterm treasuries. They were down 3%. Your corporate intermediate were down almost 4%. Your tips, the tips are your treasury interest protected securities, or inflation protected securities. They were up 1.32%. And then your junk bonds were, let's see, up 0.89%. So if you can see, the fixed income sector really didn't do very well this year, all things considered. So that's certainly been a big anchor on a lot of our diversified portfolios. And let's also go and take a look at gold. Gold this year was down about 3.5%. Silver down about 12%. So again, your precious metals and, kind of I look at them as your lifeboats, your fixed income and your metals. Those are the things that are typically going to do well when the equity markets are, faltering. So, I've caught some grief this year simply because of the the amount of metals and fixed income that I've been holding, just because, when the world starts to fall apart, we're not going to get a lot of warning. And, if I was the captain of the Titanic, I probably would have wanted twice or triple the amount of lifeboats. Casting them aside right now just to get a little extra speed just doesn't make any sense to me. But you're certainly welcome to argue with me on that one. All right. Let's go back to the last thing I did want to cover. This is Jeffrey Gundlach's top 10 predictions for 2022. Let's go ahead and start that slideshow. As the Fed starts accelerating its tapering, interest rates will rise. We're going to start seeing less stimulus to the economy. Jeffrey Gundlach, Double Line Capital CEO and Chief Investment Officer, said on Tuesday, noting that the Federal Reserve Chairman Jerome Powell has said he's likely to double the pace of tapering to $30 billion a month. It's quite likely that since the stock market and risk assets broadly have been clearly supported now for over a decade by balance sheet expansion, it's turning into a little bit rougher waters as we move into tapering and ultimately raising interest rates. Most participants in the market now believe that Powell has turned more hawkish and is likely to raise interest rates at some point in 2022. Yeah, we already knew that part. Market uncertainty will stress will follow. It's likely we'll see much more uncertainty and stress as the Fed now has decided to follow the bond markets as they typically do, and they've turned more hawkish. Number three, the U.S. economy will decline after just a few rate increases. It's likely we'll see economic problems with just a few rate hikes from the Fed, maybe only 4 rate hikes or so. Maybe it's one or 1.5 of the Fed funds rate that breaks the economy. My base case is we'll start to see trouble by the second half of 2022. I think that's certainly a reasonable prediction. Number 4, inflation will likely remain elevated until at least mid-2022. Inflation has extended beyond what the Fed projected by more than 2 or 3 months and gone on for about a year now. Inflation is likely to stay elevated based on our work and at least until at least the middle of the year. I mean a 4 handle or at least a 4 handle at least on the headline consumer price index, he said, referring to a projected 4% increase for the CPI. But he warned there's a risk there's a 7 handle year over year increase for CPI, and that could come in the next couple of months. All right, number 5, high auto pricing is another factor that will slow down the economy. This is not a good time to buy a car because auto prices are just through the roof, Gundlach said. This is another thing that will probably be slowing down the economy as we enter 2022 because autos are obviously a long-term purchase. Number 6, the U.S. dollar will decline. This is something I definitely agree with. We are on watch for seeing the dollar reverse, Gundlach said. He had expected the U.S. dollar to be strong in 2021, especially in the second half of the year, but my long-term view remains strongly dollar bearish. We're looking at a weak dollar as we look forward to the second half of 2022 or maybe 2023. But the dollar is going to go down thanks to the twin deficit problem in the United States, he said, noting that the dollar is starting to stall and referring to both the fiscal and trade deficits. Again, the dollar had climbed from around 90, I guess it was probably the summer of 20. And by earlier this week, it was in like the 96s. I did see, I think last night it had dropped down to 95 something. So again, something to pay attention to. If you start to see the dollar index slide, it might be time to move your dollar assets into something that's going to hopefully hold their value with the inflation we're seeing. Non-U.S. stocks will start outperforming when the U.S. dollar starts to decline. You're going to see tremendous outperformance by non-U.S. stocks, Gundlach predicted. Emerging markets will be a very strong performer when that happens, he emphasized. If you remember, we just talked about domestic classes versus international and how domestically U.S. stocks did very, very well across the broader indexes, and the international space. Don't think anything was over 10% for the year. So, it's definitely, a third of the return of the U.S. space this year. So, definitely not too far out on a ledge to look at that. The economy stands to further hurt if 2 or 3 year Treasury yield rates continue to rise. The 2-year Treasury yield is now at the high of the year to date, with the 3-year Treasury yield is less than a basis point below its high of the year. So short rates are on the move, he said, predicting that's not going to be positive for the economy. I don't think it's enough yet to be debilitating. But if the rates rise above 1%, the economy may run into problems, he said. Number 9, or 10, or 9, I'm sorry. Gold prices will go up when the U.S. dollar starts to go down. Gold has been shockingly stable, Gundlach said. The U.S. dollar would have to roll over for the gold prices to go up, he explained, but he predicts the US dollar will decline in value in the second half of 2022 or in 2023. Number 10, the Fed will continue. And actually, let me step back to that. So, I mean, let me bring up my chart again here. So, if we look at gold and we go out to when this all started early part of last year. So price of gold was about $1,700 an ounce prior to everything melting down and all the dollar creation. And if you see where the dollar or not the dollar, but gold is today, it's only gone up 9% since that time. But we've created about 25% more dollars in the market. So I mean, just doing some simple math. I mean, if you took $1,700 and just use that one-to-one relationship of about 25% more dollars in the market, you'd look at gold should probably be sitting at around 2,100, just based on some again some back of the napkin math here. But that's kind of where I expect gold to settle at some point, here in the near future. But until until that happens, I really don't want to step out of my gold positions. All right. The Fed will continue to defend risk assets through more money printing. I do think the Fed will defend risk assets through more money printing, Gundlach said. Adding money printing and money giveaways are with us to stay. So as far as the Fed buying toxic assets or buying assets from the Treasury, these things may continue for a while. All right. Well, that is everything that I had for today. So, as far as where we're headed into 2022, some things that I was listening to, I think Scott Adams yesterday or maybe the day before, and he was talking about things to help improve, your well-being. All things kind of start with taking care of yourself and expand out through there. And one of his suggestions was, if you're not a regular, someone who exercises regularly, just start putting it, make it a commitment. Every day at this time, I'm going to, spend 30 minutes or an hour, whether or not it's walking, doing chores around the house, lifting weights, playing basketball or whatever you might do to get your heart pumping a little bit a few times a week. It is very important. I mean, what I do personally is I put it in my schedule, and Monday, Wednesday, Friday, I try to lift weights religiously. I did take this week off since I was traveling and got some sore deltoids. It's the sad part of having my form of arthritis is the tendonitis takes whereas for some people you might get tendonitis in your elbow or somewhere and a few days it's gone. For me, it might take 2 months for it to go away. So I have to, when something starts to hurt too bad, I got to kind of take it easy for a little bit. But anyways, like I said, building it into your schedule, and once you've got your your physical well-being in place, you don't have to worry so much about what the next super cold is coming around. It bounces off of you. I mean, me personally, I haven't so much as had a bad cough or a bad cold or anything in the last couple of years. So, and it's not like I don't go out and about. I mean, I do go grocery shopping. I do, go into town from time to time. So it's not like I live out here in the woods all by myself, 100% of the time. So, taking care of yourself is number one importance, at least in my book. And, then also your financial well-being, get your stuff, sit down, whether or not it's, once a month, once a week, go through your books, see where your money's going. And, most people think to take care, well, it's on their mind to take care of their health. Whether or not they actually do anything about it is another story. But a lot of times your finances, your financial health is something that gets overlooked, or just, it's not something that a lot of people put a lot of effort into. So it is boring stuff. So I understand that. So, all right. Well, I hope everyone has a wonderful New Year's Eve and a wonderful weekend. I'll be back Monday with my normal weekly economic update. And again, hope everyone has a great evening, and I will talk to you all Monday. Bye.